Have you ever watched a chart move against you before the big move in your direction? It is not a bad luck. It is a design. And basically, the banks and institutions, they see completely different than what the retail traders see. They know exactly where the obvious areas is. Most retail traders trade between support and resistance, and they put their stop losses above resistance when they are selling, and they put their stop loss when they're buying below support. So sometimes they buy from a trend line bounce when a price is basically trending between a trend line. Most retail traders, they buy it at a trend line. When it touches the trend line, they buy it and they put their stop loss right below that. The banks, they know this stuff. They know exactly how the retail traders take their trades. So therefore, they trade against them. All right? The big banks and institutions, they don't just take small orders. They trade huge trades. They basically move in the markets. They're placing billions of dollars of trades. And in order for them to enter and exit, they need huge liquidity. And in this case, liquidity equals to money. If an asset does not have any liquidity in it, this means it is hard to exit that asset because there's no liquidity in there. There's no money if you wanted to exit, basically. So they cannot be buying and selling. If you don't see liquidity, you become liquidity. And you don't want to become a victim to the market. As we all know, 95% of the traders never make it. Only 5% become successful in trading. You don't want to be, part of those victims who are never making into trading. If you really want to become successful, you need to understand how the market works. The psychology behind every move is what you need to know. A lot of traders just take a trade. They don't know why they are taking the trade. But if you only understand liquidity and where the liquidity is, you would be avoiding this at all. You will be trading with the banks. Although you're a small trader, you will be trading with the banks. Of course, yes. All right. As you can see, the screensaver on my computer, this is what I have. This is my screensaver. Literally, I have it on my computer. This is the structure that I follow. Okay, this is my playbook. Simple, easy. Of course, timing is included. Usually I trade between London and New York, depending on when I see the big moves. So, basically I look at the market structure, and then I have to have a break of structure, and then there has to be a liquidity taken out, and then there has to be imbalance, and then supply or demand, depending on if I'm selling or buying, and then after that confirmation. Sometimes I skip this because sometimes I take a aggressive, I get into aggressive interest instead of confirm interest if I have what we call a proper risk management. Basically, if I can get into the trade early on, I don't really worry about the confirmation most of the time. And then I execute the trade, finally. All right? This is the blueprint that I follow. You can take a screenshot of it. You can go ahead and practice and see if you can do it yourself. All right? So, but in this case, I'm going to teach you guys liquidity. Liquidity is very important. Liquidity equals to money. All right? The banks, this is how they trade. Let me put this over here, okay? Look at this, guys. The banks, basically, they buy at a discounted rate. For example, if you want to buy an apple for $3 and you want to sell it for $3.25, your profit is only going to be 25 cents. You bought it for $3 and you sold it for $3.25. But if you buy the apple at $2.75, your profit is going to be 50 cents. So they buy at a discounted zone. They buy it from here, basically at a discounted price, and they sell it at a premium price. If they're entering the trade, they enter the trade at a premium area. And if they're buying it, they buy it at a discounted area. All right? So now let me show you guys an illustration of how it looks like before we go into the charts. So for example, let's say the market is coming down. We have price coming down. all of a sudden we have a break of a structure. And then we have another move, and then the price goes down. Now, this is what's going on. The banks and the institutions, they will never enter a trade right here because this is not a discounted, this is not a premium price. So what they're going to do is they're going to wait for at a premium zone. They usually wait for the price, and this becomes their liquidity. Most retail traders, what they do is they put their, give me 1 second. They put their supply zone right here. Okay, they put their supply zone right here. And what they're waiting for is when the price comes back over here, they want to take a trade to the downside. But what happens with the banks is they look at this as where retail traders are placing their stop orders or their stop losses. Take this as a resistance zone, okay? Just make it easy. They look at this as their liquidity zone for the retail, the advanced institutional traders. So this is where they see retail traders are placing their stop losses because they're going to be entering here and they want to take it down. All right. So the banks, they know exactly there's going to be liquidity sitting right there. And this is not where they're going to be selling the price at, because if they sell it from here, when they're exiting, they're not going to make enough money. So they have to wait for a premium price in order to profit. Okay. Remember, guys, the only reason why you buy and sell is to make a profit. If you're buying an egg for $2, you want to buy it at a top, basically. You want to buy it at a very cheap price, so later on when you sell it, you want to make a good profit. If you buy the egg for $2 and you sell it for $2.75, you technically made 75 cents in profit. But if you buy the egg for $2 and you sold it for like $2.20, you only made 20 cents in profit. So the banks, they don't look for small money. They want to make huge money. They want to make huge profit. This is why they need to enter at a discounted price and sell at a premium price. Okay, so you have to look at it that way. You don't just buy and sell the market. You have to think. You have to understand the engineering behind buying and selling. Why does the price move? Why do I buy this asset? Why am I selling this asset? What am I going to be making from this asset if I sell it later on? What am I going to be selling at if I buy it right now? So you have to think like a business person when you're trading, because trading is just a business. All right. Now let me go back to the illustration again. So here we can see the market came down, pulled back, and then created what we call a break of a structure. Okay. Once the market created the break of a structure, the market created what we call a break of a structure. And then price came down, made a pullback that looks like a supply zone, and then created another move to the downside. So this move is what you need to avoid most of the time. This is what we call a trap. Okay? This is what we call a trap. This is where a lot of retail traders get trapped because they think this is the actual supply zone because we have another break of a structure. They're going to be selling it from here. But the banks and institutions, they already know this is where the retail traders are going to be placing their orders at. And they're going to, after they put their order over here, they put their stop loss right above there. Okay? Right above here. And in this case, institutions already know what's happening over here. In this case, what happens, the market is going to come down. They let the retail traders think that the market is moving into their direction. They induce them. And then price goes up, takes out their liquidity. And once that price takes out the liquidity, price comes down again, retests this zone, a zone right here, and then goes up. So the market is basically all full of manipulation. Retail traders are always going to be entering at the wrong zones. Now, a lot of them are going to be placing another order over here. And you don't want to do that. So smart money, they will be entering their trade at what we call a premium zone right here. So if you grab your Fibonacci and you place it from here to the top, to the bottom, from the top to the bottom, you can see, sorry, let me change that again. Okay, from the top to the bottom. This is what we call the 88% zone. This is the OTE, optimum trade entry, basically, is what it says. The ICT traders, this is how they call it. They call it OTE, optimum trade entry. So big banks and institutions, this is where they enter the trade. And why do they do that? Because later on they can make a huge profit. It's still, these traders get, induced. This ones get induced. This ones get induced. Okay? Or the stop loss is hunted. So now price is going to come down again. It's going to act like it's going a little bit up. It's going to act like it's going up because retail traders are going to be placing another order over here. Price is going to pretend like, because you have a break of structure, remember? So now this is another demand zone for retail traders. Retail traders now, they're going to try to think this is where the market is going to be moving. Now the big banks are going to pretend like the market is moving, a little bit up just to play in the minds of the retail traders. And then price is going to continue to the downside for the small money traders, and the retail traders get manipulated. You see what I'm saying? So if you understand where the liquidity is, you will be safe and you will become successful eventually. So in this illustration, before I move into the next thing, let me show you, let me go over again. Okay, we see the price coming down, creating a pullback, and then the price created a break of a structure, taking out this demand zone or this low here. Okay, price came down, pulled back, and then price moved all the way down again. Retail traders took the trade from the first lower high, thinking this is a valid supply zone, but not thinking this price was driven by the institutions. And also, they didn't understand institutional traders, this is where they place their big orders before the big move to the downside. So therefore, they have the rest of their orders that was not filled sitting in this zone. So now they will come back, grab all this other liquidity, and then continue to the downside. Okay? So you always have to think like an engineer when it comes to the market. You have to understand exactly where stop losses are being placed, where retail traders are placing their stop losses, where the obvious areas is. This was obvious. This was obvious. Why? Because market basically I went up here. Retail traders get into the market thinking this is the valid supply zone. They pretend like, the big players pretend like the market is moving to the downside in the direction of the retail traders. Now retail traders get hunted. Their stop losses are taken out. Now price comes back to supply zone because a demand zone, because you took out what we call another break of a structure. Price comes back to a demand zone again. And then retail traders again think this is where the entry is. This is where the demand zone is. And they're going to go ahead and place their demand zone right here. They enter the trade. Price is going to move against them. Now they're going to get manipulated. All of their stop loss now basically are going to be taken out in the future. But those who sold from here also, their stop loss are also hunted. And then smart money traders are going to come into the market at a premium zone. They sell the rest of their orders, and they exit some of their orders from here. They're going to exit. And now price is going to continue to the downside. Okay, price is going to continue to the downside. All right? Retail traders get manipulated from left to right. All right, guys? So this is the mechanism behind liquidity in a sell market. Now, let me show you guys how it looks like on a buy market. So basically, I'm not going to waste your time. I'm just going to flip this chart, and we're going to look at it together. This is, okay, I showed you at a sell, and now you're going to see it at a buy, how it looks like at a buy market. So price was trading from here to here, created a high, and then a low, and then a higher high. So this was a valid break of a structure. Market went up, created what we call a inducement / SMT, smart money trap. And then price went up, Retail traders thought that this was a valid supply zone, and demand zone, and then they entered the market right here. And then those who created this big move, which are the banks and institutions, they are waiting for a discounted zone. Remember, they were selling at a premium zone. Now that they're buying, they gotta buy it at a discounted price. Why? Let's say, for example, here you have this apple for $5. Okay, and you have another apple for $4.50. Okay, which one will you buy in order to make a good profit? Of course, you're gonna go with this because this will give you more profit. By the time the guy that entered at a $5, enters the price, you already have 50 cents in profit. So basically, you will buy it at a discounted price no matter what. So now the banks, they create what we call a SMT. So SMT equals to a smart money trap. They trap the traders. This is what we call inducement. So you can call it inducement, which is to induce or entice the retail traders, pretend like they are right about their supply zone, demand zone, and then trap them. Or we can call it SMT, which stands for smart money trap. Okay, so price created a break-off structure, went up to the high. Price comes back to this area here, which this looks like another break-off structure, but it's not. Okay, this is technically a what we call a liquidity. This is what we call a manipulation zone for the smart money traders, because they know retail traders are going to be executing a trade right here, thinking this is a valid demand zone because of this structure here. So they enter the trade over here. Retail traders are going to be taking their trade over here, buying it, but then smart money traders are going to basically reverse the price and then create another move to the downside, and then take out all the liquidity that was sitting over here. For those who bought from here, for those uninformed traders, they take their liquidity, price is going to go up, create another zone, and then price is going to come all the way down at a discounted zone, and then they buy from here. When they bought from here, they left some of their orders sitting right here. So now they're going to come and take their order right here. And this is what we call a discounted price. Now they can go ahead and enter a trade, fill the rest of their orders, take out all the liquidity from the retail traders who are not informed, who don't know exactly what they're doing. Their stop losses are basically taken out. They're confused. They're frustrated because they want to, basically run away from the markets because they don't know exactly what they're doing. Then they blame their strategy. But the real thing is they don't see liquidity. You have to know the obvious points, the obvious highs, the obvious lows, the obvious double bottoms, the obvious, trend line, liquidity. All of these things you have to understand. The obvious support and resistance trading, which a lot of traders put their stop loss above resistance when they're selling, and then they put their stop loss beneath support when they're buying. So you have to be aware of this information. So liquidity is very important in the market. Now let me show you guys in the market. Let me show you guys at the chart, the real chart, okay? You'll be surprised. Every time before a big move, there is always a liquidity taken out. Every time before a big move, like I said, there is always a liquidity taken out. Okay, for example, right here, okay, let's say right here, there was a break of a structure right here. Okay, there was a break of a structure right here. Okay, now there is an area that's not mitigated right there. You see the problem here now? Okay, there was a break of structure right here. Price moved all the way up. Now, price pretend like it was coming down, and then it went back up again, trapping. Why did it go up again? Because it was trapping those who were selling this candle over here, thinking the price was going down. So their stop loss is taken out now. Okay, now price created, small internal moves, and then price comes all the way down and then takes out this liquidity right here. Takes out this liquidity right here. You see the point, guys? This area now is trapped. Anyone who bought from here thinking this move is going to end, is going to go all the way up, they basically took their order from here. Maybe they didn't exit. because there was all this chopping up going on. They're getting chopped up. They think in the market is going to come down here again and reverse, and then they're going to make their profit again. But smart money traders created this for a reason. They did all this stuff for a reason. They did this for a reason. They make this move for a reason. You know what? And now they're going to create this move. And then after that, when the retail traders enter this area, smart money traders are going to come all the way down. And then this is where they're going to execute their trades. And how do you know this stuff, guys? You can see the power of the candles. When you look at the candles, you can see how fat the candles are. Big candles means big money. Okay? Anytime you see this sort of candles, there is something going on. You see the indecision first. This is what we call an indecision. Buyers and sellers were basically struggling together. You know, price was equilibrium, trading, you know, in a very balanced manner. Price was basically making highs and lows. Now, you know, this buyers took over the market. Sorry about the chart, guys. This is a flipped chart. I'm just trying to show you guys examples, so never mind. Basically, you can see anytime you see a big candle, that's exactly what happens. The big banks are basically entering the market, and this is how they do it. You see that? This was manipulated, taken out. Price took out this thing, moved, and then price come down again. This took this again. So price was basically taking liquidity before it went high. Liquidity taken out, like you can see over here. This is already cleared. This is already cleared, and the market finally reversed at a premium demand zone. And then we see what happened after that. Explosion. Like the market clearly went all the way up. Okay? Now let me go ahead and delete this stuff. You don't need to put any indicators in your chart. You just have to be trading at the right time when the volume is up, and you're going to be executing a trade based on liquidity. Okay? So let's say here again, you can see there was a liquidity that was taken out right here. There was a break of a structure here. This is very simple, guys. Anytime there's a break of a structure, there is always liquidity involved. There was a break of a structure right there. After this break of a structure, what happened? We can see price went up, came down, and then went up, and then took out all this liquidity that was sitting right here. There was a liquidity that was sitting right here. You can see that, guys, okay? If you go to the lower time frame, this is going to look like some sort of support and resistance. So those who sold from here, now their stop loss is taken out. And then the market comes down again, because these people, they're thinking the market is going to, it created a break of a structure. Now the market is going to come down, and then they're going to buy it at a supply zone, at the demand zone, and then they get trapped again. Let me go to the 15-minute time frame and show you guys how it looks like. Because when you go to the lower time frame, you will see exactly what I'm talking about. So price went up, came down, created a liquidity hand break of a structure, but then what happened was some people think this was a valid break of a structure, so they basically thinking this is a valid break of a structure, and now they're gonna buy right here, thinking this is a valid supply, valid demand zone. So when they bought it, what happened after that? Market went up a little bit, took out the liquidity from here because there was other sellers right here who were selling this candle, and then buyers thinking that this is a valid break of a structure, then they enter right here, price goes up a little bit, takes out this liquidity, and then after that, what happened? We know what happened after that. Price comes down all the way, and then if you go to 1 hour time frame, you can see smart money traders again after the break of structure, they entered at a very high quality areas, like here, like at a discounted zone. They enter right here again, and now they make money. Price goes up, comes down, and then they make a move. Price created this, and then this is all a liquidity. As we can see, there was also another liquidity that was taken out. Every time you see things like this is a liquidity right here, guys. This is a liquidity that's taken out. You can see price creating a break of a structure. When price created a break of a structure, it came down, went back up again, and then price came down, took out this area, and then continued to the upside. So liquidity is where you need to know where the liquidity is. Every time there's a buy and sell, you have to be able to identify the areas where liquidity is sitting. Now let me go ahead and turn this chart to the downside. Okay. Now, this is what we have. Now, as sellers, basically, this is a seller market. Same thing is happening over here. Okay. Price basically created a low, and then we have a break of a structure, liquidity building up, price goes up, takes out all this liquidity, because retail traders are thinking this is a valid supply zone. So they sold from here, market created a low again, but then smart money traders, they knew this was going to be a liquidity because they did this for a reason, and then they sold it at a premium price. Price created another break of a structure. Continued to the downside. No liquidity was taken out. Price continued. And now liquidity is taken out right here. You can see liquidity is taken out right here. Price again reversed to the downside because smart money traders know exactly what to do with the markets. Now they created another break of a structure. Another break of a structure happens over here. Then what happened after that? They don't just enter right away. They don't enter from here. What happened? How did they do it? The price created a move, and then price traded below this candle. Okay, price goes up again, another move, and then trades below the low of this candle again. Let me try to zoom out. It trades below this candle again, and then price goes up. Smart money traders enter the trade right here at this supply zone with the imbalance and everything else. And you know what? At the end of the day, you can see anytime there's a discounted zone trade entry and a premium zone trade entry, you have to look at if you're basically selling, you sell it at a supply zone. When you're selling at a supply zone, you have to look for huge powerful candles, and when you're buying at a demand zone, you have to look for a huge buy candles. Guys, this is what liquidity means. Liquidity basically means a trap. Be aware of those traps. And the times that this happens is between Asian to London session. Before London session opens, do not take any trade. And the reason why I tell you this is because this is when most of the liquidity is building, and this is when most of the manipulation for London session traders basically happens. This is where they take advantage. All the traders that was trading in Asian session are being manipulated during London session, and most of the traders who have been trading for London session are being manipulated during the New York session. By the way, if you find this video helpful, please go ahead and subscribe. Make sure you like this video. And those who follow me and subscribe to my channel, I haven't made a video in a while. And the reason why was because I've been very busy lately. But I'm going to try to be consistent because we almost headed at the end of the year, almost 8 weeks left before 2026, if God wills. So I'm going to try to post consistently as much as I can. My name is Jamal. Again, for those who don't know me, please go ahead and join the family. Subscribe. Most of you guys are watching the videos and not subscribing. But please, I suggest that you go ahead and subscribe. And if you have any questions, try to put that in the comment sections down below. Again, all the links are going to be down below. Free Telegram, my ebook. If you're trying to upgrade your knowledge, check that out down below. Again, this is your brother Jamal. Until next time, stay legendary. If the video is long, please excuse me for that. I try to make this as simple as I can. And if you guys want, I will make more videos about liquidity and try to see if we can understand this even more in depth.